Most middle-class families are not irresponsible. They earn solid incomes, 80,000, 120,000, sometimes 180,000 household. They pay their bills on time and contribute to retirement accounts. They refinance when rates drop and monitor their credit. They follow mainstream financial advice and avoid obvious mistakes. On paper, they should be stable and steadily progressing. Over the past decade, income growth across countries like the United States, Canada, the United Kingdom, and Australia has been meaningful in nominal terms. Employment markets have been relatively strong in recent years. Participation in workplace retirement plans is common among professionals. By traditional metrics, this group should feel secure. And yet, financial stress remains stubbornly high. Surveys consistently show that even six-figure earners feel behind. Many households would struggle to absorb a $5,000 unexpected expense without rearranging cash flow. If income increased, why didn't stability follow? That question is not emotional, it's structural. The issue is not dramatic overspending or reckless behavior. It is something quieter and more persistent. The real pressure often comes from fixed cost creep. Small permanent upgrades accumulate into structural obligations. These obligations don't adjust easily when income fluctuates. The result is a shrinking margin despite rising earnings. Fixed cost creep rarely looks dangerous in the moment. It appears as a slightly larger mortgage for a better neighborhood. It appears as a $650 car payment instead of $450 because the financing is attractive. It appears as upgraded insurance, higher property taxes, or added convenience services. Individually, each decision feels earned and rational. Collectively, they convert flexible income into locked commitments. Fixed costs behave differently from discretionary spending. They persist month after month, regardless of mood or market conditions. When fixed costs rise faster than income, financial oxygen thins. Households may earn more, yet feel tighter. That tension is arithmetic, not emotion. Most people assume that more income equals more safety, but safety is determined by margin, not revenue. Imagine a household earning $120,000 net with $78,000 in annual fixed costs. Add $20,000 of variable spending, and savings land near $22,000, roughly an 18% savings rate. Over time, income rises 20% to $144,000. During that same period, housing, vehicles, and lifestyle upgrades raise fixed costs by 25%. Fixed obligations climb toward $97,500 per year. Margin compresses rather than expand. The household feels busier but not freer. Higher income did not produce higher flexibility. Raises rarely create wealth on their own. They create capacity, and capacity tends to be deployed. If income rises from $100,000 to $115,000 and the savings rate remains 10%, annual investing increases modestly. But if that raise justifies $700 per month in new fixed payments, surplus disappears. Over 20 years at a 7% return, $8,400 annually compounds into hundreds of thousands of dollars. The opportunity cost is invisible in the present. Lifestyle upgrades feel like progress, but they often reduce future optionality. Businesses understand this dynamic clearly. Revenue growth without cost discipline weakens resilience. The permanent payment economy amplifies the problem. 30-year mortgages are standard and often maximized. 6- or 7-year car loans normalize high monthly payments. Subscriptions convert one-time purchases into ongoing obligations. Streaming, software, cloud storage, meal services, and memberships accumulate quietly. Every recurring payment consumes financial oxygen. When fixed costs approach 70 or 80% of take-home pay, flexibility narrows sharply. A household earning $10,000 monthly with $8,000 in fixed costs has little breathing room. One disruption can erase stability quickly. The structure becomes dependent on everything going right. Mortgage approvals reinforce this fragility. Banks underwrite debt based on income continuity, not optionality. If a household qualifies for a $750,000 home instead of $600,000, the extra $150,000 feels validated. Yet that extra thousands of dollars in payments and upkeep annually translates into payments and upkeep. The same logic applies to vehicles financed over long terms. A $400 monthly difference invested at 7% for years compounds into meaningful capital. But finance consumption captures that capital before it compounds. The cost is not just interest paid, it is the lost growth of uninvested surplus. That growth gap widens silently over decades. Dual-income households face another structural risk. A couple earning $90,000 each may build fixed costs around $180,000 combined. Mortgages, childcare, cars, and vacations align with that total. If one income disappears, the system struggles immediately. Fixed costs cannot shrink quickly enough to match the drop. High income can coexist with low resilience. True stability means designing life so one income can carry the structure if necessary. That may feel conservative, but it preserves optionality. Optionality is a form of wealth rarely measured in net worth statements. Silent wealth erosion also occurs through under-automation. If investing depends on leftover cash, lifestyle absorbs the surplus first. Automating 20% of income into investments before spending protects margin. Starting early amplifies this protection through compounding. Investing $15,000 annually at 7% from age 25 can double the outcome compared to starting at 35. Small recurring expenses compound as well. An extra $300 monthly invested over 30 years grows into hundreds of thousands of dollars. The damage is rarely visible day to day. Compounding magnifies quiet decisions. The issue is not discipline, it is architecture. Cap fixed costs below what feels comfortably affordable. Automate surplus before lifestyle expansion captures it. Design your structure so one income can sustain essential obligations. Protect profit margin the way a disciplined company does. Financial freedom is less about extreme income and more about controlled structure. Flexibility often matters more than visible status. Options matter more than appearances. When margin is preserved, income transforms into autonomy. When margin is ignored, even high earnings can feel fragile. If you earn six figures, own a home, and contribute consistently to retirement accounts, you should feel secure. That's the formula most professionals were handed. Study hard, build a career, buy property, invest for the long term. Stability follows income. Security follows assets. That's the expectation. In countries like the United States, Canada, United Kingdom, and Australia, six-figure income is commonly positioned as the threshold where financial anxiety fades. You've crossed into the comfortable category. You're no longer supposed to worry about money in the same way. That's what we've all been told. And yet, a significant percentage of six-figure earners report living paycheck to paycheck. No exaggeration, no moral judgment, just contradiction. Households earning $150,000 or even $200,000 annually still described feeling tight at the end of the month. How can high income and financial stress coexist? How can someone with a strong salary and solid career trajectory still feel financially fragile? The answer isn't hidden in reckless spending. It's embedded in what we choose to optimize. We've quietly optimized for visible wealth over invisible net worth. Bigger homes, recognizable car brands, better neighborhoods, curated vacations, lifestyle signaling that confirms progress. These are tangible, socially reinforced upgrades, but invisible metrics often lag behind. Net worth growth slows. Liquid savings remain thin. Optionality shrinks. You can look financially successful while being structurally constrained. The tension comes from optimizing for appearance instead of autonomy. You can have a strong salary, a high credit score, and a beautiful home, and still be fragile. Those metrics largely measure your ability to manage debt payments on time. They don't measure independence. A 780 credit score signals reliability as a borrower. It doesn't indicate how long you could survive without income. A $900,000 home signals purchasing power. It doesn't guarantee flexibility. These markers create confidence externally while masking internal leverage. That disconnect produces quiet stress. Consider the credit score myth. A credit score measures payment history, credit utilization, length of accounts, and borrowing behavior. It rewards active participation in debt systems, but it does not measure net worth, liquidity, or cash flow margin. A person with $20,000 in savings and no debt may have a lower score than someone with multiple large loans paid perfectly. One is less leveraged, the other is more optimized as a borrower. A perfect borrower is not the same as a wealthy person. Then there's the approval trap. Financial institutions determine how much you can borrow based on debt-to-income ratios. If a bank approves you for an $800,000 mortgage, it feels like validation. But approval is not alignment. Approval means the bank believes you can service the debt under expected conditions. It does not mean the payment structure supports your long-term optionality. Stretching to the maximum approval amount may reduce your margin for decades. Long loan terms normalize high obligations while disguising their lifetime cost. 30 years is a long time to be committed to one decision. Emotional spending and status drift add another layer. Social comparison has accelerated in the digital era. You're constantly exposed to peers upgrading homes, vehicles, and experiences. Algorithms amplify aspiration. Purchases are frictionless. One click, 0% financing, same-day delivery. Small emotion-driven decisions compound. A $500 impulse purchase feels harmless, but if similar spending occurs monthly, that's $6,000 annually diverted from investment. Over 25 years at 7%, that stream could grow beyond $400,000. Emotion doesn't calculate compounding. Systems do. Delayed investing compounds the illusion. Retirement always feels later. Early in your career, you assume future income will compensate. At 30, contributing 8% feels acceptable because raises are expected. At 40, lifestyle is more expensive and contributions still feel temporary. The math is indifferent to optimism. Investing $20,000 annually at 7% starting at 25 can produce multiples of what starting at 35 yields, even if the later investor contributes more per year. Time is the most powerful variable. Present bias consistently underestimates its impact. Automation becomes structural defense. If investing happens after spending, lifestyle absorbs the difference. If 20% of income is automated before it reaches your checking account, behavior adapts downward. This isn't about discipline, it's about architecture. Wealth building accelerates when friction protects long-term capital instead of consumption. Rebuilding financial strength requires reversing visible priorities. Layer 1 is reducing status pressure. Choose housing and vehicles based on margin preservation, not social validation. Layer 2 is converting recurring payments into assets where possible. Redirect surplus from depreciating obligations into appreciating or income-generating investments. Layer 3 is building liquidity before expanding lifestyle. A fully funded emergency reserve and meaningful brokerage balance create psychological stability that a higher mortgage never will. Now, imagine two futures. Person A earns $160,000 at 35, lives in a premium home, drives new vehicles, and appears impressive. Their fixed costs consume 75% of take-home pay. At 55, they are still servicing large obligations and hoping markets cooperate. Person B earns the same income, but caps fixed costs at 55% of take-home pay. They invest aggressively and maintain liquidity. At 35, they look understated. At 55, they have optionality, reduced hours, career pivots, geographic freedom. Money is not for display. It is for control over time. If your finances feel tight despite high income, the issue may not be effort. It may not be intelligence. It may not even be spending in isolation. It may be design. Visible wealth is easy to recognize. Invisible wealth requires restraint and structure. The illusion fades when you measure success by flexibility instead of appearance.